Welcome to the Tax course by Mergerverse. So in this video, we'll be covering convertible instruments. Now, in one of the previous videos, we have discussed about structuring, and in that we have discussed 5 reasons for structuring. Now, these are the 5 reasons which are reproduced here. These are control of company, fixed return to investor, duration of the funding, benefit to founders or future exit. And all of these 5 problems can be solved with the help of a convertible instrument. So let's understand it deeper. We take the example of control of company. So when a business is started or company started, the founders generally invest a nominal capital. A majority of investment is done by investors, either at the seed stage or later on. And considering the amount of the investment by investors is going to be much more than the investment by founders, it is very likely that if we just compare the investment amount, the control of the company goes into the hands of investors. However, this may not be what both investor or the founders want, as founders of course are the ones who started the company and they would want to control the company, whilst investors are there to get a return on their capital and not do the business. So we can be solved using convertible instruments. Here is an example. The founders invested rupees 50 lakhs as their initial capital initially in the company. The company then raised 5 crores from investors in the seed round. The valuation on the date of investment, let's assume, is 5.5 crores, would give investors almost 90% of the company. Now, here, instead of issuing equity shares to the investors, the founders can issue convertible instruments like CCPS with a fixed time frame on which they will convert into equity, or in a future event like an exit or IPO or further fundraise. So let's understand from numerical examples. So on the date of investment by investors, the founders will own equity shares. Let's say they own 5 lakh equity shares of 10 rupees each for the investment of 50 lakh, and they issue CCPS to investors of rupees 100 each, 5 lakh CCPS of 100 each, with the simple conversion ratio of 1:1 on the date of conversion. And let's say after 5 years the CCPS convert, and at that time the valuation of the company has increased to 50 lakhs. So these CCPS would convert into 1:1 ratio and would now will convert into 5 lakh shares and will give investors 50% stake. So the founders were able to get a stake from 10% to 50%, whilst investors would also gain a return from on their 5 crore of 20 to 25 crore. So in 5 years their investment got 5x. So this is how the CCPS helps for both, without giving away the control of the company, while ensuring that the investors get the return they want. Now, how the conversion ratios can be linked in the CCPS? So they can be simple 1:1 as we discussed in the previous example, or it could be linked to a valuation, or it could be based on a fixed return that the investor desire, or in the period of exit. We'll cover this in more detail in another topic on capital structure, in which will go through examples of various instruments that can be issued by the company. Now, the types of convertible instruments that can be issued. So there are majorly 4 types, which are compulsory convertible preference shares, compulsory convertible debenture, then optionally convertible debentures, and optionally convertible preference shares. So what is important to note for all 4 is, if these are issued to non-resident investors, there will be FEMA guidelines that will have to be followed, and that will be again something we will cover in a separate video. There could be some other kinds of convertible instruments, of which partially ESOPs and MSOPs can also be considered as convertible instruments, and there are other instruments that are issued outside of India that may be relevant if we are doing some cross-border structuring. So again, before we leave, some points to remember in case of convertible instruments. So in case of investment by non-residents, as we discussed, FEMA will need to be considered, since there are certain implications under FEMA which have to be considered. Then Companies Act valuation. Now under Companies Act, an issue of preference shares, you need to consider that the preference shares cannot be issued below the fair market value determined by a valuer. and then on issue or conversion, we'll also need to evaluate if there are implications under the Income Tax Act. So thanks for watching, and do watch the structuring video along with this or before this so that you are able to grasp some of the topics we have discussed here.